Hey guys, this is Colby Kingard at EagleRock Realty and Property Management. If you're a real estate agent and you're watching this video, you're in the right place. Today, we're going to discuss unknown yet known terms that not everybody knows. Make sense? There are some terms that we real estate agents use freely in conversation, like cash flow or appraisal, but what about the ones that people may use but they don't really understand? Let's get into that. A housing bubble happens when there's a lot of buyers, there's not enough for sale, so the prices go up. Those prices can rise higher than what anyone thinks the house is worth, but to get the house, the opposite of a housing bubble is a housing crash, where you got a lot of people trying to sell their houses, not enough people who can either afford loans or even looking to buy. So you get houses that sit on the market for longer and eventually sell at lower prices. A seller's market refers to which side of the deal holds the most power. For a seller's market, it's the seller. They've got a lot of buyers waiting for a chance to buy their house. So if it doesn't work out with one buyer, or a buyer won't agree to their terms, they'll just cut off and deal with somebody else. And the flip side of that is a buyer's market, where buyers hold more power in the transactions than the sellers do. If a buyer doesn't get their concessions met, they can go find another house because there's plenty of houses waiting on the market to be bought up. The next couple of terms we have are different ways people can buy. It just depends on what the buyer needs. One type of way of purchasing real estate is through a conventional loan. This is the one most people are familiar with. You get with a bank, you talk to a lender, they lend you an amount of money, and you purchase the home. Usually this is most attractive because the interest rates here are going to be lower than your other options. Another type of loan to purchase real estate is a hard money loan. Now this one usually is better for people who are looking for a short-term ownership. Maybe they're buying and flipping. Interest rates can be higher and they usually rely on collateral. Depending on how the market's going, sometimes you don't have time to do your homework before you submit an offer. In these cases, you would submit what's called a blind offer, or offering sight unseen. This one speaks for itself. You haven't seen the property, you haven't stepped foot in the property, yet you're tossing your name in the hat because you know if you wait even another day, it might be gone. Something you really need to be aware of on a national scale when working in the real estate field is inflation. Inflation is when the value of a dollar decreases. Inflation can be caused by a number of reasons. Maybe there's too much money in circulation, or maybe the prices of goods and services is just going up because they're harder to come by. Inflation impacts everything, real estate to Taco Bell bean burritos. When I was a kid, I could buy a bean burrito there for 89 cents. Now they're $1.29. Go figure. Inflation is something you really need to have a good grasp on during your time in the real estate agent career field. Cold calling is when you call somebody out of the blue. They didn't ask for your business. They probably didn't give you their number, but you're calling them anyway to see if there's something you can do for them, some kind of business or service you can provide. It can be horrifying to do at times, but it also has tremendous payoff, and something that sets apart the really successful from the less successful, the agents who are willing to take the time to do it. As a real estate agent, a lot of times people are going to ask you, hey, how much do you think this is worth? What do you think it could sell for? And a way to find that is through comparable sales. Comparable sales is when you take recent sales that have occurred, maybe the last 6 months, sometimes up to a year, and you compare what those properties sold for per square foot or different features that they have, and compare it to the property in question so you can come up with the most accurate number possible of what it could sell for. Comparable sales is not always the route to go when pricing real estate. Sometimes you need to gauge it on the income approach, which is how much income is this property going to generate? Is it an apartment building? Is it a duplex? What kind of investment is this? How much cash flow, how much return am I going to see on this investment month over month, year over year? Those two approaches, the comparable sales approach and the income-based approach, can yield two very different numbers when evaluating real estate. Use your best discretion as to which one you should use. So guys, we hope these terms helped you in your real estate endeavors. Hope you can understand what they mean. Hope you can use them in everyday conversation. Hit like, subscribe, check out some of our new videos coming up soon. Peace.